All right. Well, thanks for rolling right into the next section on the future of the Fed. And I couldn't have two better co-panelists to discuss the topic with me. So unfortunately, at least in my view, the Fed as a topic and the future of the Fed could not be more timely, nor could it be more pivotal in terms of the transformational moment that we're currently in. Just yesterday, the administration filed with the Supreme Court a request for an administrative stay, seeking to preclude Governor Cook from continuing in her post, pending resolution of a suit involving President Trump's attempt to remove her on a for-cause basis. But of course, that's just one of many things that have been going on with the Federal Reserve recently. And so I think when we put all the different pieces together over the coming year, we know we're going to have a new Fed chair. We know that resolution, not just temporary, but probably in a longer term way regarding Governor Cook's case is going to come out. And so we're going to find out whether the for-cause requirement with respect to the removal of Federal Reserve governors actually has any teeth. I anticipate in the next year, we will have a decision on the merits from the Supreme Court on Humphrey's executor and the future of independent agencies generally. My guess is that we are not going to have independent agencies other than the Fed, and the questions around the Fed's capacity to remain independent in the coming year. So this really is a time where what the institution looks like going forward is likely to be very different than what we've known recently. And I want to get right into the topic, but I do think it's also a really important time then to also bring in a little historical perspective. I think there's been a sense recently that the type of independence that we've seen at the Fed and concerns about central bank independence generally have started to become conflated with kind of the neoliberal era and the particular type of independence that we've seen over the last 40 to 50 years. But of course, concerns about direct government control over monetary affairs goes much, much deeper. If you go back to the 1935 Act, which effectively is what gave us the construction of the current Fed, there was an active fight in Congress, even though FDR was at the height of his popularity. And it was precisely because there were profound concerns about giving the president and partisan interests too much control over the money supply, over money. And there was discussions then over what had happened during the First World War and World War I and World War II. There was an incredible awareness among elected officials, first, that Congress under Article 1 has an important role to play here, but also that the structure of accountability for Federal Reserve, or excuse me, for central banks had really different effects across different economies during those periods. So the money supply doubled in the US and the UK, but it effectively tripled in France, it quadrupled in Germany. And this was actively being debated on the floor of Congress. So it's important to realize that these issues go deeply back. But of course, the Fed today plays very different roles and has taken on a very different flavor. So I think it's both important to understand kind of what's gone right and what's gone wrong over the last 40 or 50 years, but then also have a little bit of historical perspective as we move forward over what's at stake going forward. And I have to say, like I said, the reason I'm so excited to be joined here by Jeremy Kress to my left and then Skanda Amarnath is we're bringing different lines of this conversation together. Actually, I thanked Dennis before for bringing us all together. But one of the things I really like when you look at the full set of different topics that we are covering today is it's very much about financial regulation, what brought us all together, but it's also much broader about economic policy and an awareness of the two fit together. And I think sometimes we have different views of the Fed because in some ways it is like the classic elephant situation where those who are in FinReg are busy kind of looking at the trunk, and those who care about monetary policy and actually making sure that the Fed is not only trying to fight inflation, but also to really promote opportunities for employment are looking at different creatures. And so I think it's important actually that we bridge the conversations that too often have run separately. So I have two people. I'm the only person on stage who has not worked at the Federal Reserve. So I will also say that they are both outstanding lawyers. So both of them try to hide it. So today we're going to get into that a little bit. Jeremy Kress is at the Ross School of Business and is an incredible faculty member there, the head of their Center for Financial Policy and Legal Policy, and has really been just a very active voice on the financial regulatory front and has served at the board in the legal department, focusing on the financial regulatory pieces. And it's just been a really trying to help us understand what's at stake and what's going on with not just the way the Fed, but the OCC and the FDIC and the other regulators are really transforming the regulatory landscape, and I think has particular concerns and justified concerns in light of what he's seeing in those domains. Then we are joined by Skanda Amarnath, who again has really, as co-founder and current CEO of Employ America, has done an outstanding job reminding the public, reminding Federal Reserve officials that the Fed does have a dual mandate. Recently, it's become, back to the statutory text, a triple mandate, which is part of the statutory text, though I will say it's being employed in an opportunistic way, given the current moment. But where he really has done a great job helping to remind us, going back to Dennis's points at the beginning, that what we care about are people in jobs, are people having the opportunity to economically get ahead, and who is economically getting ahead. And that to be able to engage in those conversations, we need a different, also deeply informed view on how the Federal Reserve is using monetary policy, but also how monetary policy is but one piece of a broader financial, regulatory, and economic policy landscape, all of which need to be working together if we actually want to create ripe opportunities and meaningful opportunities for Americans. So I think it's going to be a really great debate. I'm going to give each of them a discussion, not a debate, a little bit of time to lay the groundwork. I'm going to come in with questions, and I really also want this to be interactive, so make sure you have your own questions. And so with that, I will turn it over to Jeremy.
Thank you, Kate. Thank you, Jennifer and Simon and Dennis, for convening us. Looking forward to discussing. I want to start by addressing the Cook case and Fed independence. When I read the DC Circuit opinion in the Cook case, which was issued this Monday, it feels like a year ago, but it was this week. When I first read it, like many of you, I breathed a sigh of relief because I think it came out the correct way, prohibiting the president from removing Governor Cook on wholly unsubstantiated allegations. But then I read Judge Katz's dissent. Judge Katz is a Trump appointee to the DC Circuit. Of the 4 judges who have now opined on Judge Cook's case, the district court judge and the 2-judge majority in the DC Circuit, Judge Katz is the only Republican appointed judge among the 4 of them. And Judge Katz, as a dissenter, would have allowed President Trump to remove Governor Cook on these wholly unsubstantiated allegations. He would have found that Judge Cook did not have due process. She was not entitled to process to defend herself before summary removal. And given that partisan split, but for what were really lucky draws in the district court in the DC Circuit, I think we could be in a very different place right now. And that's a problem because we're not getting a lucky draw at the Supreme Court. I know, Kate, you and others are doing great work with the litigators trying to bolster Governor Cook's case in front of the Supreme Court, but I think we need to be clear-eyed about the writing on the wall and the way the Supreme Court may ultimately come out on the merits of Fed independence. We will eventually, regardless of how the Supreme Court comes out, we will eventually come to a day when Democrats are back in charge, and we are going to have to decide collectively what to do, if anything, about Fed independence at that point. I think that there will be a understandable desire to try to revert back to the way things were with technocratic independence of the Fed, particularly on monetary policy. We can try to amend the Federal Reserve Act to make that a reality. And I would support those efforts to make that a reality. But I think we also need to be prepared for the reality that amending the Federal Reserve Act is very hard. And we should start now exploring how we can use the levers of power to achieve our own ends at the Federal Reserve. We cannot live in a world where the Federal Reserve claims independence when Democrats are in charge and bends to the will of Republican bullies when they're in charge. So I think that in parallel tracks, as we try to defend Governor Cook and we try to reinstantiate Fed independence, we also need to lay the groundwork to prepare to use the Fed's great levers of power to do the things that we've been trying to accomplish for many years, to make the economy more equitable, to make the financial system less extractive. And now that those levers of power are on the table, we can't turn our backs on them and pretend like they don't exist.
Yeah, so I largely agree with Jeremy's points, and thank you all for inviting me. I think that we're kind of at a fulcrum point right now where there is probably one of two outcomes that are pretty soon we're going to figure out where we are. One is that Lisa Cook can be removed, and there's a shadow docket ruling that happens, and then we are in the world of Fed independence is functionally dead, right? That is just like any semblance of independence is gone, and we have to really explore a lot of the questions that Jeremy rightly raised. And then there's the other world that may also be very quickly clear, and I would say what we learned 2 days ago was actually quite telling, which was when the Fed cut interest rates 25 basis points. Lisa Cook was on the Board of Governors at that time and voted, and Steve Myron, who is also the sitting chair of the President's Council of Economic Advisors, also voted at that meeting and dissented, calling for a 50 basis point rate cut. And there has been the long, very loud whispers of Trump wanting to take over the Fed and that he was going to succeed, most recently by Larry Kudlow, once advisor to the president. And if that was going to happen, you would expect that maybe Steve Myron would try to be persuasive to some of Trump's previous appointees, Chris Waller, Michelle Bowman, people who are probably have a very different view of a lot of different financial, monetary, regulatory policies than a lot of us in this room. And yet they did not vote with Steve Myron. They did not vote for a 50 basis point rate cut. That itself was very notable. It was more glaring by the fact that when projections and forecasts were submitted, Steve Myron had a pretty obvious, he was a very obvious outlier, and quite rosy projections for unemployment, GDP growth, but at the same time calling for very rapid rate cuts. So it kind of stuck out that way, and I think it lacked a lot of credibility. This is someone who has called for the president's ability to fire every FOMC member, not just Fed governors. This is someone who has called for potentially exploring Treasury default in certain contexts, called for dollar devaluation, things that I think most congressional Republicans would not be willing to accept from a Democratic nominee. And so we have someone who I think most people understand to be a bit of the president's person on the Fed right now, and clearly breaking a lot of norms and precedents about what counts as independent judgment on the Fed. And so you could have imagined a world where maybe he was actually trying to persuade members, potential allies in the FOMC, and that there really was the possibility of, with just one more member, then the Board of Governors would take on a more partisan character in favor of Trump, and then maybe they could shape the FOMC from there. So that seems to be less likely, but it is all rendered moot if the president can fire Lisa Cook based on a disputed allegation, right? That allegation alone is enough. And even if it is not judged on the merits until much later, it's functionally the case that if the president can move faster, then the courts are able to stop him or want to stop him, then we are functionally away from the world of Fed independence. And that raises a lot of big questions about where we go from here around, like, can we have any sort of independent judgments around monetary policy or otherwise? It's obviously gotten a lot harder in the world where Humphrey's executor is all but dead, right? It's all but dead, and the Fed is the one carve out. Or do we have any ways of exploring what can be done in the future? And these are actually very open questions, and we're really not going to be able to answer that until we get an opinion from the Supreme Court about what to do here. I think it's funny that all these questions are coming up, and at the same time, I was invited to testify for this House Financial Services Committee 2 days ago. They decided to time it exactly at the time of the FOMC meeting, or at least when the statement was released and Powell's press conference. And it was about less mandates and more independence. Never mind the grammatical issues. But congressional Republicans are very keen to be mad about how we have a maximum employment mandate, even though that was the main credible justification for cutting rates on Wednesday. So already you are dealing with this sort of keeping up with appearances problem. And at the same time, they were also speaking to the virtues of Fed independence, as if it is what we need are less mandates, fewer mandates, and that itself will lead to more independence, ignoring sort of the firing of Lisa Cook and what its implications are. And so there's clearly this just clear discontinuity between what congressional Republicans were willing to support and what was actually going on in the real world. And that just suggests that there's pretty weak oversight, I'd say, from congressional Republicans, and that means we're really there is some level of inevitability that the executive branch is sort of calling all the shots under Republicans, and it just looks very different from whatever you can get done with congressional Republicans currently. It's just a very bizarre state of play that way, and given that fact, how we kind of approach what monetary policy looks like in the future, what all kinds of policy that we want to have some level of independent judgment, informed judgment, ideally some policy competence and continuity, which we typically associate with more independent agencies. Those are all open questions. We're going to learn a lot over the next 12 months about what that can look like, especially when we have such a constrained sort of judiciary, where the judiciary clearly seems to hate it in all contexts, but seems to have a willingness to make an exception for the Fed. We're about to find out how big that exception is, and we'll find that out basically depending on whether they decide to let Lisa Cook serve her position, or whether they decide actually any cause is good cause. Never mind the 14-year staggered terms that are for Fed governors. Never mind the fact that for cause was pretty intentionally introduced in 1935 alongside a set of reforms that gave Senate-confirmed appointees the first opportunity to vote on monetary policy. That was not the case before 1935. And so we're just witnessing history kind of unfold this very week itself. And I think we're going to find out a lot in the next week itself.
Yeah. So let me follow up right on that. I mean, it is this interesting history that, of course, like monetary open market operations was originally given to the Federal Reserve banks. It was seen primarily as a way of kind of bolstering profitability at the Reserve Bank level, and it was only subsequently that they started to realize that actually in situations where the gold constraint is not entirely binding, that this is actually one of the most powerful mechanisms available for affecting kind of credit availability throughout the financial system. And so there was this like iterative fight starting in the 20s, but really bubbling up in 33 and then in 35 Act over where power should lie, right? And so you had FDR, really Mariner Eccles as the spokesperson for the plan from the administration, really saying we want a newly constituted Board of Governors, and the decision should lie solely with the Board of Governors. So there was going to be an advisory role for the Reserve Bank presidents, but it was otherwise going to lie entirely with the president, effectively, and entirely with the Board of Governors. And then you had, on the other hand, Carter Glass, who'd been key in the 1913 Act as well, styles himself as kind of like a Jeffersonian, so kind of the opposite side of the centralized power that central banks typically have, coming in and saying, no, the way that we deal with this isn't just through the longer terms. I mean, he's actually on the record saying like, oh, I don't really think the cause thing matters that much, which is an interesting moment to have, but really fighting like crazy to make sure power remains with the Open Market Committee and the Reserve Banks as voting members on the Federal Open Market Committee. And so you end up with, I think, the FOMC really embodying the compromise. And this is going both to the legal issues and the legitimacy issues. Because I think there is this core question is like, if we don't have independent agencies, what do we do with the Fed? Is there a way to distinguish the Fed? And we saw kind of a line, quasi-private, unique historical, but like we're trying to figure out like what that actually means. And to the extent that we're honest, I do think both the legal issues and the legitimacy issues go hand in hand. And it was a point in time where there was trust in technocrats, there was trust in experts, and we were willing to hand it over to these independent agencies. And that was true across the board. And I think both the legitimacy issue has been brewing up for a very long time, and understandably and appropriately so. And so that is kind of weakening, and that is what has allowed the Supreme Court to come in with a very aggressive version of the only way we get accountability is to have accountability through the White House and through the executive branch. And so the question is, can we do something different? And so I have to admit, I'm personally of the view that if there's a way to really distinguish the Fed, well, at least one possibility is having regionalism be true regionalism and having be some kind of accountability through this very distinct structure. And that was a lot of what the 1935 Act was about. But there are these other kind of questions of like where we can draw, both for normative purposes and for legal purposes, how we draw those lines. And so I'd love to have you each, you spoke to it a little bit, like speak a little more about not only what it should look like, but why it matters to you. I mean, I think, Jeremy, you nicely said, let's defend it and critique it. And I actually think that's what we're all doing. At least most of us are doing in this room, is simultaneously defending it from the current assault and trying to figure out how we can make the institution better. But I was wondering if you could, each of you, just like unpack a little more kind of what you would like to see, not just in the next administration, but like going forward from that. I think it's going to take years.
Yeah.
So in 10 to 15 years, what is the new medium that you think might be viable, and why would you like to see it?
Yeah, I like your regionalist approach, and I look forward to your writing on the topic. Let me suggest one other way that we could potentially square the circle. We are in an uncomfortable and really nonsensical situation right now, where the White House insists that the Federal Reserve is ostensibly independent on monetary policy and subject to White House control on regulatory and supervisory policy. That seems incoherent to me and unsustainable. I don't know how the board can be independent for one purpose and not for another. I think we should be open, for many reasons, to stripping the Fed of its supervisory and regulatory authorities. That solves a couple of problems at once. Number one, it solves the problem that the Fed has historically been very bad at those jobs. And that's just a function of the Fed is an inherently small c conservative institution that is dominated by economists who care very little about bank regulation, if we're being honest. So let's put bank regulation and supervision back with the OCC and the FDIC, people whose job it is primarily to worry about the state of the banking system. So stripping the Fed of regulatory responsibility solves that problem, and it addresses the issue of how can an institution be independent for one purpose and not independent for another. If the Fed focused solely on monetary policy, perhaps we could all agree about its independence. There's complexities with this approach, right? Like, how do you delineate what's supervision and regulation versus what's monetary policy? It's a spectrum. There's not a clear way to delineate it. We would need to think hard about where to draw those lines. Where does emergency lending, discount window lending reside? Is that still with the Fed, or is that with another institution? So I grant that this is not a fully thought out plan yet, but I'm just suggesting that we should be open to this approach as one way to solve the independence problem.
Sure.
I mean, I think a lot of this stuff is path dependent. We're going to have a much better idea about this stuff 1 year forward than we are today. And so sort of the humility of saying there's a lot of different paths we may end up finding to be potentially optimal if, depending on how the Supreme Court rules and how we are actually seeing these events digested by the public and by the administration and by people across the aisle. And I think just I want to spend a little bit of time discussing even just the reasons for Fed independence to the extent they're useful. They're clearly weaponized in a lot of different directions over time historically, and often not necessarily good. Nevertheless, the reason you want to have some dose of independence, competence involved, probably put your political priors aside to the extent you can in matters of monetary policy, is there are some long-term interests that you'd like to have, right? If, let's say, President Trump was able to basically pack the Fed with the people he wants, and he got interest rates down to 1%, right? I'm sure that would have an effect on lowering interest rates generally, but there also would be other things that market participants have to think about, and there are risks that kind of emerge from that. People obviously talk about it in terms of, well, that can stoke a lot of inflation, and if there's inflation, then that obviously is just bad. I think it also goes beyond that, though, which is you're also seeing right now, despite the Fed cutting interest rates 100 basis points last year, and basically we're priced for a world in which interest rates will go down below 3% by the beginning of 2027. Maybe that's because markets sort of believe that that Trump will have some influence over the Fed. Maybe it's because they think the economy is just going to weaken. And yet, long-term interest rates, the third mandate, moderate long-term interest rates are part of the Fed statutory objectives. Those actually haven't moved much, right? They're still right about the same place they were last year. And you see that when you see sort of, what do you call it, a steeper yield curve, higher levels of interest rates generally, it's all quite consistent with investors wanting more risk compensation. There is some level of associated with interest rate risk, with inflation risk long term. And that's obviously just cost that eventually borne by the public, by anyone who's borrowing money, whether you're a household or a business. And at the same time, we've also seen the dollar weaken quite considerably. And these are all things that are, I don't want to blow them out of proportion, but if you were looking for signs of institutional erosion in markets and in sort of how we're priced for different outcomes, you are seeing that right now, that we are seeing the costs of institutional erosion. And obviously, you don't want to, the thing is, in this scale, probably not the biggest deal. The worst outcomes that are kind of associated with more dysfunctional emerging markets are the things that you obviously do not want to like get anywhere close to, because that's the bad state of the world. And so when we think about what we want from in terms of independence in the monetary policy context, there's just a lot of those sorts of considerations. I will say, it's not as if the Fed is the only institution where long-term stability matters a great deal. And there are a lot of institutions that are implicated by the Fed, by the Supreme Court's kind of, I'd say, pretty reckless move into this world of saying agency independence is all but a fiction. The FERC, Federal Energy Regulatory Commission, the Nuclear Regulatory Commission, these were all kind of bodies set up in part to have a view towards the long term, represent broad majorities, and not just and ideally cross-partisan, so that policy is stable. Because policy, if it has some stability, has greater traction in sort of setting up long-term incentives. And so we're kind of really deviating from that world, and it does like mean there's less stability, and probably means policy on some level, you can't rely on the credibility and long-term incentives to be able to achieve your outcomes. It may open up opportunities to do more disruption and more short-term sort of policy moves, and that's just a very different playbook from the one that I think most people who have been thinking about policy over the last several decades have thought in terms of. So we're just gonna have to sort of flip the switch there in terms of saying this is if it's the case that there really are no exceptions and independence is basically a fiction.
Yeah, I mean, there is a constant challenge to the time and consistency problem is by no means unique to the Federal Reserve setting, a monetary policy setting, even though it is a nice kind of concrete area in which those issues play out. There is also the core issue, which really Scott is getting at, where in reading broadly the executive's authority under Article 2, what the court is really doing is massively scaling back Congress's authority under Article 1, which is the much more expansive article of the Constitution, and with good reason, to say there are certain types of objectives where we not only want to have those objectives, we think that they're important. We think that democracy is not just about majority rule. We think democracy is also about guaranteeing a certain set of civil and economic liberties to individuals so they can be meaningful parts of the demos. And then in order to achieve those objectives, there are certain types of institutional structures that we think are actually going to be critical to helping us to achieve those aims. It still operates in a way where it's embedded and accountable through all three of the constitutionally enumerated branches, but is not sitting so cleanly in one that is accountable solely to one and not to the other two. And I think that is the core challenge right now, where we have a Supreme Court just taking a much more formalistic approach and really trying to jam everything into one of the three branches in a way that is effectively taking power from Congress and taking away also the ability for us as a collective democracy to support certain types of structures that allow us to achieve longer term aims, whether that's financial stability or whether that's the capacity to fight inflation and therefore promote kind of greater stability in those regards and enable certain types of planning among private actors. So going back then to the question, you nicely dodged it, and I hate to do this, I'm going to put you on the spot. I mean, there is this question, both as a legal matter, as a normative matter, over what do we think about the future of the Fed? And it does seem like there is this challenge where a lot of what the Fed does on financial regulatory policy and supervisory authority isn't that different than what the FDIC and the OCC do. It is hard to imagine a state of the world where the FDIC and the OCC are not brought down within the coming year, if they were not brought down already by the shift towards unitary executive. So whether we think that's optimal or not, I think that's the direction we are very likely headed. And so there is this question then of the oddness of the splitting the baby, of like, I can fire you if you like did something I don't like for regulatory policy, but I can't fire you for monetary policy. And like, trust me, I'm going to be honest about that. Versus like, maybe we actually need to think about how do we start to split this up differently. And again, there are interesting challenges. I mean, Bank of Japan does it, right? So Bank of Japan like has secondary authority. I think the Fed, because my instinct is the Fed has to have the discount window. I don't think you can get that out of the Fed. I think the nature of the discount window, the nature of 13.3 means those things have to be within the Fed because it's the only way that they're credible, because they're the only one who have the capacity to create the elasticity. But I do think if you're going to do that, you need oversight authority. But so then the question is, if you have kind of some backup oversight authority, like what are your thoughts on whether or not, I know it's not like your focus, but do you have reflections?
It really depends on the political state, right? Like
Yeah.
that ends up being most important. In the case of like right now, I would imagine there's a pretty clear direction sent from OCC and FDIC towards sort of exploring every sort of avenue of deregulation in a way that is not quite the same at the Fed right now, right? Even with Michelle Bowman being sort of the key regulatory official within the Fed. And so you get probably, the Fed is sort of structurally both suboptimal, and at the same time you get some benefits from insulation that otherwise don't get placed with OCC and FDIC, where you'll get probably much more vigorous regulation under Democrats, and you're not going to get that. You're going to get the opposite under Republicans. So the question is like, how much independence do you want, and how much do you think you can achieve the objectives you want within a presidential term, right? That is, I think, actually a really important question for basically 7 to 8, well, basically all 8 years, but really for the 6 years of President Bush's sort of term in office, 2 terms in office, right? There was a very clearly light touch approach to regulation and willful ignorance around a lot of the imbalances that materialized. And that sort of ignorance was not really punished until very late in the game, right? And so to me, that itself is sort of just indicative of, if you want to have robust regulation that sticks, that is typically where some political insulation and independence is very helpful, especially where some of these phenomena we're talking about are not things that are very easy to root out or easy to kind of see be punished in terms of incompetent regulation. And so I think this is just kind of a question of what, like, if you think some of the things you need to do are really important, but the payoffs of them are not necessarily going to materialize in the short run, that is where like you have to think about what kind of structure really fits that. I think as a realistic matter, like we are headed to a world where there's going to be like less ability for the Fed to be a credible regulator and supervisor, and so you kind of need to think about the alternatives. And I think that is an unfortunate world. I think ideally you would have a separate regulatory and supervisory body independent of the Fed and independent of pure executive whim. And yet that does not strike me as, in the short run, very feasible. And how you build the political consensus for it seems even harder, especially since regulatory matters have really mostly cut across partisan lines. And to the extent there's ever been partisanship for the last, 10 years, it's all been towards deregulation. And that is like just that is a world that we have not seen the pendulum shift back to any sort of interest among those on the other side of the aisle towards really figuring out how to actually approach regulation in a constructive manner.
So I would just add that if we are going to keep supervision and regulation at the Fed, then it's got to become part of the job description for Fed nominees. We cannot continue nominating governors who can't be bothered to learn about or care about supervision and regulation and just go to their 8 FOMC meetings every year and call it a day. We've got an imbalance right now where Republican Fed governors are pretty much across the board deregulatory, and too many Democratic Fed governors don't care. And so if we're going to keep this job at the central bank, we need central bankers who care about regulation and supervision.
I would agree with that.
Everything, which is an interesting personnel is policy issue and intention, not just having multiple mandates, but having multiple different hats that you're wearing. I mean, another key asymmetry that you're facing for financial regulation is not just that there's a massive, you're making investments now for payoffs much more down the road, so it's really hard to do it. But we also have, apart from the unitary executive, seen a dramatic transformation in how the courts are approaching matters of administrative law that I think strategically make it far easier to reduce regulatory burdens and to create regulatory burdens, particularly in an environment where the funding, when it comes to litigation, when it comes to lobbying efforts, is so incredibly asymmetrical, despite everything that Dennis is trying to do to balance it out. So we do have an asymmetry that I think exists in that regard too, that is going to be fundamental and have to be addressed. Taking a step back, what would be, what is your sense, I guess, of the way to do this? If Humphrey's executor goes down, which I'm assuming that it's going to, what is the nature of the carve out for the Fed? I mean, so we have a little bit of a carve out, but what is the way that you would, and we're going to, partly because we have the Lisa Cook things, but what do you think is a carve out, putting on whether your lawyer hat or your policy hat, is the carve out that makes the most sense to try to find some way to say this body is different?
This is a question of whether what will or what should, but if it is a question of,
It could be either.
yeah, I mean, it does strike me that obviously there's clearly a lot of borrowing from, I don't know, Aditya Bamzai and Aaron Nielsen's sort of work on these matters, and they have a pretty, I say, we all think it's bizarre, but it probably is the historical understanding that the Supreme Court is probably leaning upon, and that is one in which monetary policy powers are treated somewhat differently. And the Federal Reserve System is treated as something that, because the Federal Reserve banks are technically private institutions, even as the Federal Reserve Board of Governors is a public institution, that they are going to lean on that sort of decentralized regional structure, that it has private corporations that have some level of private control, make them different. And that makes them different. The monetary policy powers make them different, and the regulatory powers, there have to be some way of separating that out to be put under a greater presidential control. That strikes me as probably the way that the Supreme Court wants to move forward. There's another question about how they're going to adjudicate just the matter of for-cause removal, because for-cause is pretty vague. It is worth noting that the Banking Act of 1935 was passed after Humphrey's executor came down, and there is at least the law around presidential removal itself was evolving from what it was in the Myers decision in the mid-1920s to what it was in the mid-1930s under Humphrey's executor. So Congress's understanding of what was kosher and what wasn't also shifted, right? So I think that's something that the court has to reckon with. If you're going to have any kind of removal protections, they have to be meaningful, right? Like if they're not, then why bother with this whole charade of quasi-private system and banking tradition? And I don't know, this is all going to be new stuff for all of us to kind of absorb, but it doesn't make sense to go through all of this if the for-cause removal protections are worthless. And clearly the government's stance right now is that they're worthless, that they are basically all cause is good cause. And so that these are going to be just challenged to disentangle. I suspect they want to move in the direction of pretending there's some level of independence that's separate from monetary policy than regulatory policy. And so I think they'll make these carve-outs. To me, I do think there will be something to learn from that about some of these other agencies as well, things that maybe we would like to have independent. I don't think we shouldn't fetishize independence, but we also should say there are some useful things about how it supports continuity, competence, acting with broad supermajoritarian political will, like how we actually achieve those ends are going to be really important in a lot of other contexts. And you need to first start from having that political consensus, but if you do, there may be ways to graft some of the understandings from this pending decision for how we what the way forward is. So hopefully I can do something.
Yeah, no, it does. I would say, so Jeremy, I'll give Jeremy a chance to answer that, but let me quickly. Jeremy nicely pointed you to the DC Circuit opinion, and I do think the dissent is a very valuable read if you want to understand the challenges that might arise at the Supreme Court. I will also say Solicitor General John Sauer in the appeal, the application for stay to the Supreme Court, I think summarizes beautifully exactly how the administration sees these issues spelled out in the alternative. And it's not only strong form of the unitary executive, it is, due process is a flexible notion, and whatever process was due was supplied in this instance. And so willing to say that with a credible face to this court, it is a striking read in terms of what we're potentially going to expect. Sorry, go ahead.
Yeah, so just getting back to the question of like, how do you situate the Fed in a post-Humphreys world? I think beyond the idea of hiving off the regulatory responsibility, I'm reluctant to answer the question because you broke it, you fix it, right? It's not our problem to swoop in and save the Fed after the White House has totally bludgeoned our conception of independent agencies. I think, the market will, I think, eventually react if Fed independence is truly gone. And at that point, let them own it. Let them fix it. It's not our mistake, and at some point, they've got to be responsible for the outcomes.
I see a response here.
I just say I wouldn't bank on sort of near-term market turmoil. It may happen, but one also say like there are a lot of other ways that the cost of Fed independence kind of sneakily kind of emerge, and so to this point, right, the stock market didn't move that drastically at all, really, based on like the announced firing of Lisa Cook. That obviously was sort of before at the time, middle of August. So don't like count on market turmoil being the thing. It's not as if like markets are perfectly informationally efficient all the time, and certainly in dealing with matters of long-term risk. I do think the right level of kind of apathy about this is to say like whatever happens will happen with the Supreme Court, and the costs of it are things we should be aware of, but it may not be things that like are obvious to voters or even elected officials. I think it was kind of telling among sort of conservative circles, they were kind of grinning with glee that when Cook was fired, the markets didn't move. It was kind of the thing that, if you like, the interview between Aditya Bamzai and Jack Goldsmith. So they're kind of saying, and it's telling also that after the appellate ruling came down, they did not immediately go to the Supreme Court to ask for emergency relief, because Tuesday was the beginning of the FOMC meeting, and obviously it would have taken up the news if there was going to be a Supreme Court ruling that came down at the same time or during the FOMC meeting to probably take Lisa Cook away if that's the case. So they were somewhat sensitive to the headline news risks here, and they're trying to dodge them. But to this point, we haven't seen any market turmoil really related to the Fed independence. I think you could say that risk premiums associated with interest rate risk and specifically long-term interest rate risk and long-term inflation risk have increased, and the dollar is weakening. I don't know if I want to attribute every single bit of that to the erosion of independence, but it is also pretty consistent with that outcome too.
And just to be clear, I'm not saying don't fight. We absolutely should fight, and I don't want to sound apathetic about it, but like we're living in a world now, or we're about to be living in a world that they created, and it is incumbent on them to create the carve-out, however hand-wavy and nonsensical it may be.
All right, so I'm going to open it up for questions, but first I want to ask one final question, and then I'm going to open it up. So I see Pat over here, and then Anat, and then Hillary. So get the mic over there. So the last question, I mean, both of you have testified, we've all testified at various points in time. What role would you like to see Congress playing that it's not? I mean, I will say in the recent confirmation, there was a role that I would have liked Congress to have played, saying that maybe you need to withdraw from a particular role in order to become a governor, and would have I could not have imagined actually that as a possibility even 6 months ago. But beyond that, what are the roles for either of you where you feel like Congress can really and should, in a way that's potentially viable or in your dream state, play a different role than it has been?
So it's a little difficult, given the current state of Congress, to say that I want more congressional oversight. We talked about the Adam Tooze op-ed from this weekend, and he builds off of Lev's suggestion of a triennial review of Fed budget by Congress, and I'm not convinced that that's the way to go. I think one potentially productive way that we could increase congressional oversight of the Fed is having more, if we keep the Fed's many mandates under that umbrella, having more frequent oversight hearings on those topics. It's not enough to have Jay Powell come up twice a year to testify on monetary policy and the vice chair for supervision come up twice a year to testify on regulatory policy. We should have, each of those Fed governors who chair various committees on payment systems and consumer and community affairs, we should hear from them. There should be more accountability among the Fed governors for the areas that they're responsible for. That might be a little way to shine some more transparency and bring more accountability to the Fed if we continue to charge it with so many different jobs.
Yeah, I mean, ideally, especially when you think, Fed independence is about independence from the executive. It's not to say it should be independent from Congress. It actually should be highly accountable to Congress and really nested in an understanding that Congress is it's congressional power that's being exerted, not quasi-private power, right? Like this is supposed to be a congressionally led institution. And before we get to sort of even the question of accountability, hearings, and sort of, there's actually two things I think that are missing, at least from my testimony on Wednesday, which was oddly scheduled during the sort of when the Fed meeting statement came out. There has to first be genuine interest in the issues, which seems to be lacking. You had a series of congressional Republicans who, without realizing it, were basically arguing for higher interest rates, but didn't in all but name. And they were saying we need to get rid of the maximum employment mandate, just focus on price stability. And if you did that, you would obviously be focused on hikes instead of cuts right now. And at the same time, they're also still talking about independence without even paying attention to the fact that we're intentionally not paying attention to what's going on with Lisa Cook. So there's like a lack of interest among most congressional members of Congress who profess an interest in monetary policy. And then you have to be informed. And I think those two things itself, to have enough interest in being informed to actually have competent views that credibly check the substantive decisions of Fed officials. And that also seems to be a pretty sizable gap. We got a very deferential approach from congressional Republicans to the confirmation of Stephen Myron. And Tom Tillis basically waved the white flag and said, I don't think he's independent, I don't care. Because I think he's going to be gone soon, which honestly is a bad reading of the Federal Reserve Act, because he can stay a lot longer than just a few months if President Trump decides not to refill the vacancy with someone else. And so Tom Tillis seemed to just say, I don't really like it, but whatever. And even all the other sort of senators involved were basically of the view that it's President Trump's choice, and if he wants to move fast and break things, that's up to him. So we have like no ability to even think for Congress to even exert some level of institutional independence. And that seems to just be all about, if we were trying to fix that, it's really about fixing Congress as an institution, which is a much bigger set of issues that we have to address than telling that go beyond even the scope of Fed reform.
I'll start with Pat.
Thank you. Jeremy, I have a couple of questions for you in particular, and one keys off of Kate's observations. To the extent the Fed is deciding these agency independence cases, including possibly the Fed's, based on constitutional doctrine, in other words, unitary executive theory, and constitutionalizing its holdings, it's much more rigid. And so in that case, how can we change that law? Yeah. And second, if we are to strip out supervision and enforcement, what do we do about systemic risk oversight?
Yeah, great. So caveat, not a constitutional lawyer for good reason. And I'm going to dodge the question, Pat, because I note that the DOJ in front of Supreme Court right now is not arguing that the for-cause removal protection is unconstitutional. They're just arguing that the for-cause removal was satisfied in Governor Cook's case. To Skanda's point, if we're allowing for-cause removal on the basis of the thinnest, least substantiated allegations, then it kind of collapses into no-cause removal anyway. So I'm going to stick to my knitting and steer clear of the constitutional issues. Systemic risk, great question. I mean, Pat and I, of course, have written a lot about systemic risk regulation. And Pat, you're probably won't be surprised to hear that my response is that the answer is to beef up FSOC and have it fulfill its statutory responsibilities for systemic risk oversight. I think the roles that the Fed is designed to play in terms of overseeing non-bank SIFIs, to the extent we ever have actual designated non-bank systemically important financial institutions, you could move that to OCC or to the FDIC. Again, without claiming to have fully thought through these issues, I think the systemic risk one is one that you could address by just shifting responsibility among the agencies.
All right, so I'm going to go to Anat and Hillary, and then we'll move over to Jared.
So I want to go back a little bit to the regulation, obviously, and to one thing that you didn't really talk about, which is sort of lender of last resort and sort of this mix of, buying asset, lending to some people and all of that, which was sort of played out in the bailouts as well as in COVID and kind of all the time. So those authorities and how they interact also with regulation. So just to set the stage, we all know here that the Fed has been a spectacularly bad regulator, okay? Now, whether central banks should regulate, that's a good question. And one of the reasons we should really rethink that is that they really have the power to cover up their own failures to regulate, everybody's failures to regulate. So just because they're central banks, so they can throw money at any problem, and they do. So my question is really, longer term. I know short term, we got issues right now that seem more, but the whole discussion of independence, again, is like, okay, it's for like the other regulators, except I think it's to some extent worse. Now there are maybe worse regulators in the Fed, but not many. And so how do we get kind of, when Paul Volcker said to combine all the regulators, he said at the Fed, which is not what I want. But you need people like Caroline Crenshaw who can speak. I mean, you need more debate on these regulations, just like we have them on, on securities laws or a few other things. They took the consumer protection, of course, it's dead, et cetera, et cetera. So I'm just saying for financial regulations in general, maybe we should just remove it out of the Fed with whatever good and bad comes of it. But at least we're clearer, and there isn't the sort of ability to throw money at your own failures.
Actually, there's a bunch of questions, so I'll go straight to Hillary, and then we'll.
Yeah, mine sort of continues the theme, which is, I am very interested in moving financial regulation out of the Fed. I'm biased. I like the Australian proposal, which is they have the RBA is just a central bank, and then they have a prudential regulator and a market conduct regulator. But if we do that, and this is what I'm interested in hearing the thoughts of the panel, if we do that, this is a sort of a riff on Pat's question, but particularly around 2023, there was a lot of interest in the intersection between monetary policy and financial stability, right? So the impacts, and I mean, because of what happened with Silicon Valley Bank, et cetera. And so do we lose something about when they're thinking about monetary policies impact on financial stability? Do we lose anything there by hiving the financial regulation out? And maybe we don't, but.
All right, let's pass the mic down, but let's go ahead and have our panelists address these questions.
I mean, in theory, yes. In practice, not really, right? That seems to be the case. Like you could imagine a Fed that was deeply interested in sort of the interactions between interest rate risk and financial stability. And I don't think you can point to how the Fed sort of oversaw those risks and approached those risks, both as Fed governors making monetary policy decisions, and then also obviously Reserve Bank presidents had supervisory authority and largely ignored those issues. So they clearly were there's a gap there, whether it is just an unfortunate gap, which unlikely, or it reflects sort of incentives and institutional priorities. I think it just suggests there's not the informational synergies that you would have hoped existed if you were trying to make the case for consolidating monetary policy with regulation. And so I think on that score, just the track record speaks for itself.
Great.
I have to say, you look at the volume of the overnight reverse repo, and I think between like a slightly leaky floor and financial stability, like there's a revealed preference that comes through.
Thank you. Thanks for a great panel. Comment and a question. Skanda, I take your point, which I think is a good one, that if the Fed set interest rates too low in an economic sense, markets might respond with a risk premium that raises the longer end of the curve. So, but my comment is that the variable I'd worry most about when Fed independence gets compromised is the anchoring of inflationary expectations. That's the one that has historically been negatively correlated with, or I should say positively correlated with independence, more anchoring. And that's a cheap way of achieving some pretty important sustainable developments. My question is a really gnarly legal one, and I apologize if this sounds too granular, but it's, as I know you know, it's super important. Is it the case that the fact that regional bank presidents have to be approved by the board in years that end in a 1 or a 6, is that a cultural tradition, or is that legislation? Is that part of the FRA that you'd have to get Congress to fix, because it really needs fixing? It's a massive accident going out to happen that I know I never thought about until the last few months. And if it's something that could be done without Congress, that would be awesome. But I wonder what your take is on that.
I mean, I believe it's actually part of the Federal Reserve Act. That being said, it is really striking when you look at the act that there are 14-year terms that have staggered implementation precisely because they didn't want a single president to be able to play too much of a role choosing any particular composition or size of the board. And so I think the way that they were able to reconcile that is, and this is really fought out, is the board approval was just that. It was approval of a decision that was made first and foremost by the reserve banks. And the composition, at that point, you still had Class A directors, who are the directors elected by the banks, able to vote. So you had 2/3 of the local boards still elected by member banks. So the notion was, and this, you can see a similar trade-off with how they did the discount window. There was a very clear understanding. Because one of the things Eccles tried to do, going back to 1935, is he actually wanted the board to have to approve it every single year. And Congress said, no, 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 we're going to do it on an annual basis or on a 5-year basis. But it really was with the assumption that there's a fundamental difference between what you can initiate and what you approve. And going back to Skanda's point earlier about open market operations, the board already had approval authority over open market operations given to it in the 33 Act, but they understood that approval was different than the ability to initiate. And so, and just one other point on this is everybody's making a big deal of this, and I understand why they're making a big deal of it right now. The first Trump administration, the Office of Legal Counsel issued a memo effectively saying, given concerns about constitutional avoidance, we think that the board has the ability to remove any reserve bank president for pure policy reasons at any point in time. So like the current Trump administration's understanding of their authority to change the composition, or at least to remove reserve bank presidents, doesn't happen to hinge on the fact that there is this approval that's coming up and pending soon. All right, we have Art, I think, for the last question of the day.
I would raise 2 points.
Sorry, did you guys want to chime in on that? I just jumped in. Go ahead, sorry.
I think, you know, the Fed independence to me has had a dark side. Paul Tucker pointed it out, I thought, very eloquently in his book. You get over mighty servant or master, however you want to put it. And I think that has had, you know, they've made the Fed the Supreme Court of Finance, and they've had all the pathologies that we have with the Supreme Court, because Congress is easy and happy to hand off all the hard decisions to the Fed and blame the Fed, instead of having to bear accountability for their own work. And I think that's been very unfortunate. I think we should think about, I also think the private Federal Reserve presidents voting on monetary policy is just wrong. These should be politically appointed and confirmed people. And I think the Fed's independence from the politics, to me, has ended up with Fed dependence and capture by the industry. I think it's been a completely captured agency, except under Paul Volcker. He's the last really independent chair I can think of that hasn't really danced to the industry's tune. So I would encourage people to think about everybody is appointed and confirmed, but you require geographic diversity. You require bipartisanship. I think Commissioner Crenshaw has shown us how important it is to have bipartisan members of these boards, clearly with the ability of the president to appoint a majority, but at least some bipartisan representation. And I think you could put other diversity. It's interesting. There's a community bank president or community bank experience requirement that hasn't been enforced. So why is that in the statute if Congress won't enforce it? So I mean, I think that the way the Fed is set up now is another excuse for Congress to do nothing and blame the Fed for any problems they foresee. I think making it an accountable agency, but with appropriate diversification and bipartisan composition, might actually force Congress to get back in the game and do something positive.
All right, we are over time. Any final closing words? I think that's a great place to end. All right, thank you all for your thanks, and join me in thanking the great panelists.
Great job.